Hiring slowed down in June. Home prices didn't get the memo and kept moving higher. And the Fed is sitting in the middle of all of it, trying to figure out their next move. There's a lot to cover this week, so let's dive in. Good afternoon. I hope everybody had a great 4th of July weekend and took some time to enjoy it with your family. It is always worth pausing to remember what we are actually celebrating, a country that took a pretty significant gamble on an experiment 250 years ago. Like any experiment, there have been flaws and failures along the way, but to see how far it has come is genuinely moving. Now to the reason that you're here. Last week was a shortened one with the markets closed on Friday for the holiday, but that did not mean there was a shortage of headlines worth paying attention to. We got some additional relief on the oil front as OPEC confirmed they will be increasing their production target, which has continued to push prices lower. That is good news for the bigger picture. Lower oil prices should translate into lower inflation readings in the coming months. And as we have covered before, lower inflation is what ultimately opens the door for lower mortgage rates. Last week was jobs week, so let's get into what took place and what it means for real estate heading into the summer. Here are your headlines. June job growth came in well below expectations, with the economy adding 57,000 jobs compared to the 110,000 forecasted. Payroll gains for April and May were also revised lower by a combined 74,000 jobs. Meanwhile, the unemployment rate edged down from 4.3 to 4.2%. Here's where it gets interesting though. Because the headline number is not telling the whole story, full-time employment actually dropped by 514,000 jobs last month, and part-time employment fell another 53,000 on top of that. So while the top line jobs number looked passable, the underlying details are softer than they appear. The other thing worth paying attention to is where the hiring is actually happening. The bulk of recent job growth is concentrated in education and healthcare, sectors that are driven by long-term demographic trends, not by a broad, healthy expansion across the economy. That is a very different signal than seeing widespread hiring across industries, and I think it gets glossed over when people just look at the headline. And then there's the unemployment rate, which did tick lower, which sounds like good news until you look at why. The decline was largely driven by 720,000 people leaving the labor force entirely. When people stop looking for work, they are no longer counted as unemployed, which makes the rate look better than it actually is. That is not a sign of a strengthening labor market. That is people exiting it. The full picture here is a labor market that is softer than the headline suggests, and that is exactly the kind of data the Fed will be paying close attention to heading into their next meeting in a couple weeks. Now, according to ADP, private employers added 98,000 jobs in June, below expectations for roughly 110,000 new jobs. Hiring increased across businesses of all size, with small businesses leading the way. So the bigger takeaway here is the wage data is worth paying attention to, because people who switched jobs over the past year saw a pay increase of 6.6% compared to 4.4% for those who stayed put. Now, on the surface, that sounds like workers still have some leverage, but the more telling part of that stat is how much that gap has narrowed from where it was just a couple years ago. When that spread was wide, it meant companies were competing hard for talent and workers had real options. The fact that it has closed down considerably tells you the labor market has cooled off more than people realize. Now, when you combine that with the concentration of hiring we just talked about, what you are really looking at is a job market where the opportunities are narrowing, the competition for workers is softening, and people still on the sidelines are having a harder time getting back in. Now, this isn't a crisis yet, but it is also not the strong labor market that some of the headline numbers would have you believe. Now, in housing news, home prices rose 0.8% from March to April, following a 0.7% increase in March, for a total gain of 1.5% over the 2-month period. After adjusting for normal seasonal patterns, prices were essentially flat, but home values remain 0.8% higher than they were a year ago. Separate data from the Federal Housing Finance Agency told a similar story. While seasonal adjusted prices were mostly flat in April, actual home prices increased 0.7% in April, 1% in March, and 0.9% in February, a combined gain of 2.6% over those 3 months. Now, this one's pretty straightforward, and it is a point I find myself making a lot. Homeownership builds wealth over time, and the numbers back it up. A $500,000 home appreciating at 4% annually adds $20,000 in value over the course of a year. That is $20,000 in equity you are building without doing anything other than owning your home and making your payment. Now, you're not going to find that in a savings account right now, but that is just 1 year. And the full benefit of homeownership appreciation really shows up when you go through a complete real estate cycle, which typically runs somewhere between 7 and 10 years. Now, when you compound that 4% annually over that kind of timeline, the equity picture looks a lot different than a single year snapshot suggests. That is the conversation worth having with buyers who are fixated on where rates are going today instead of looking at the long game. Now, the other thing worth noting is that seasonal adjustments can make appreciation look softer than it actually is this time of year. Strip that out, and the underlying trend is still moving higher. And with inventory still limited and demand holding steady, there is nothing in the current supply picture that is going to meaningfully cool prices anytime soon. So, for anybody sitting on the fence waiting for prices to drop, this data does not give them the signal that they are looking for. The buyers who are in the market right now are building equity while they wait for rates to come down. The ones on the sidelines are not. After the last 3 weeks of Fed meetings, inflation readings, and labor market data, this week is a relatively quiet one. And honestly, that is not a bad thing. Two reports worth keeping an eye on are Thursday's existing home sales and weekly jobless claims. Wednesday also brings the release of the Fed meeting minutes from their latest meeting, which could give us a little more color on where the committee's heads are at and has the potential to move markets depending on what is in there. I'll be in touch next week with a full breakdown, but for now, have a great rest of your day.